What if the most expensive housing markets in California are suddenly losing value right now? In 2026, several major cities are seeing prices drop faster than expected, creating opportunities most buyers never thought possible. From Silicon Valley to coastal hotspots, the shift is already happening, and many people are missing it. Is this the beginning of a major correction, or the best chance to buy in years? Stay with us as we break down the cities where prices are falling right now. Number 10, San Jose. San Jose, located in the heart of Silicon Valley, has long been known as one of the most expensive housing markets in California. Home to major tech companies and high-income professionals, the city experienced massive price growth during the pandemic boom. However, in 2026, the situation is shifting. Home prices are now seeing noticeable declines as demand weakens and inventory begins to rise across several neighborhoods. One of the biggest reasons behind this drop is the wave of tech layoffs and hiring slowdowns. Companies are becoming more cautious, and fewer high-paying jobs mean fewer buyers who can afford million-dollar homes. At the same time, remote work is allowing people to move away from costly urban centers like San Jose, choosing more affordable cities instead. This shift is quietly reshaping the local housing demand. For buyers, this could open up rare opportunities in a market that once felt out of reach. Sellers, on the other hand, may need to adjust expectations and price more competitively. Watching interest rates and job trends will be key here. San Jose may not be crashing overnight, but the correction is real, and it is something smart investors are already paying attention to. Number 9, Stockton. Stockton has always been a city known for its dramatic housing cycles, and 2026 is proving to be no different. During the pandemic, home prices surged as buyers searched for more affordable options outside of major cities. Stockton quickly became a hotspot for commuters and remote workers. Now, that surge is reversing, and prices are beginning to fall as demand slows down significantly across the area. A major factor behind this decline is economic instability, combined with reduced migration into the city. As remote work becomes less dominant, fewer buyers are willing to move far from job centers. At the same time, rising interest rates have made monthly payments less affordable, pushing many potential buyers out of the market. This has led to more homes sitting unsold, increasing pressure on sellers to lower prices. For investors, Stockton presents both risk and opportunity. The market can shift quickly, and timing becomes extremely important. Buyers looking for lower entry prices may find deals, but they should carefully analyze long-term growth potential. Keeping an eye on employment trends and population movement will help determine whether Stockton stabilizes or continues to decline further in the coming months ahead. Number 8, Riverside. Riverside, once a booming housing market in California's Inland Empire, is now experiencing a noticeable slowdown in 2026. During the pandemic, this city attracted a wave of buyers looking for more space and relatively lower prices compared to coastal areas. Home values surged quickly, but that rapid growth is now cooling off as demand begins to weaken across many neighborhoods. One key reason behind the decline is the changing work landscape. As more companies require employees to return to offices, long commutes from Riverside to cities like Los Angeles are becoming less appealing. Higher fuel costs and travel time are pushing buyers to reconsider their options. At the same time, rising mortgage rates have reduced affordability, making it harder for new buyers to enter the market at previous price levels. This shift is creating opportunities for patient buyers who have been priced out in the past. Sellers, however, may need to adjust expectations and accept lower offers than they would have seen just a year ago. Riverside is not collapsing, but it is clearly correcting. Watching commuting trends and interest rates will be essential for anyone planning to buy or invest in this changing market soon. Number 7, Bakersfield. Bakersfield has long been considered one of California's more affordable housing markets, attracting buyers who were priced out of larger cities. During the recent housing boom, demand increased as people searched for lower-cost living options. Prices climbed faster than expected, but in 2026, that momentum is slowing, and the market is beginning to show clear signs of decline across several neighborhoods. One major factor driving this shift is the city's limited job market compared to coastal tech hubs. While Bakersfield offers affordability, it lacks the same level of high-paying employment opportunities. As remote work becomes less common, fewer buyers are willing to relocate without strong local job prospects. At the same time, higher interest rates are making even affordable homes less accessible, reducing the overall number of active buyers. For those considering entering the market, Bakersfield still offers relatively low prices compared to other California cities. However, buyers should focus on areas with stable rental demand and economic activity. Sellers may face longer listing times and increased competition. The market is adjusting after rapid growth, and while it is not collapsing, the slowdown is real, making careful planning essential for both buyers and investors right now. Number 6. Fresno. Fresno has traditionally been known as one of California's most affordable housing markets, attracting first-time buyers and families seeking lower costs. During the pandemic housing surge, prices in Fresno rose quickly as demand increased from both local and out-of-state buyers. In 2026, that rapid growth is slowing down, and home values are beginning to decline as the market adjusts to new economic conditions. One of the main reasons behind this shift is overvaluation during the boom period. Many homes were priced aggressively, and now buyers are becoming more cautious. Rising mortgage rates have also played a major role, reducing affordability and limiting the number of qualified buyers. As demand softens, more homes are staying on the market longer, forcing sellers to reduce prices to attract attention. This creates a unique opportunity for buyers who have been waiting for more reasonable pricing. Fresno still offers strong value compared to larger California cities, but careful research is essential. Investors should pay close attention to neighborhood trends and rental demand before making decisions. The market is not crashing dramatically, but it is clearly correcting, and those who understand timing could benefit from better deals in the months ahead. Number 5. Sacramento. Sacramento became one of California's fastest-growing housing markets during the remote work boom, attracting buyers from more expensive cities like San Francisco. With relatively lower home prices and more space, the city saw a surge in demand that pushed values higher at an unusually fast pace. Now in 2026, that rapid growth is reversing, and the market is showing clear signs of cooling down. A major reason behind this shift is the gradual return to office work. Many buyers who once prioritized distance and affordability are now reconsidering location, especially if commuting becomes necessary again. This has reduced demand in suburban areas around Sacramento. At the same time, higher mortgage rates are limiting purchasing power, making it harder for buyers to afford homes at peak prices reached during the boom. For buyers, this changing market could offer a second chance to enter at more reasonable prices. Sellers, however, may need to adapt by pricing competitively and being more flexible during negotiations. Sacramento still has long-term potential due to its location and growing economy, but the current correction is real. Paying attention to job trends and migration patterns will be important for anyone looking to make a move here. Number 4. San Diego. San Diego has long been seen as one of California's most desirable coastal cities, known for its beaches, lifestyle, and strong housing demand. During the pandemic, home prices surged as buyers rushed to secure property in this highly sought-after location. In 2026, that trend is beginning to reverse, with prices showing signs of decline as the market adjusts after years of rapid growth. One of the key reasons behind this shift is that prices simply climbed too high, pushing affordability to its limits. Many buyers are now stepping back, unable or unwilling to meet elevated price points, combined with higher mortgage rates. As demand softens, more listings are appearing on the market, giving buyers more choices and reducing the urgency that once drove bidding wars across the city. For potential buyers, this may be a rare opportunity to enter a market that once felt unreachable. Sellers, however, may face increasing pressure to reduce prices or offer incentives to attract interest. San Diego remains a strong long-term market due to its location and lifestyle appeal, but the current correction is noticeable. Careful timing and financial planning will be important for anyone considering buying or selling in this shifting environment today. Number 3. Los Angeles. Los Angeles has always been one of the most iconic and competitive housing markets in California, attracting buyers from around the world. Known for its entertainment industry, diverse neighborhoods, and strong economic base. The city saw massive home price increases during the pandemic. In 2026, that upward trend is slowing down, and prices are beginning to decline in several key areas across the city. One of the biggest reasons for this shift is the growing affordability crisis. Home prices reached levels that many buyers simply cannot sustain, especially with rising mortgage rates, increasing monthly payments. As a result, demand is weakening, particularly in higher-end neighborhoods where prices were already stretched. Fewer bidding wars and longer listing times are becoming more common, signaling a clear change in market dynamics. For buyers, this could present new opportunities to enter the Los Angeles market at more reasonable prices. Sellers, however, may need to adjust expectations and be more flexible during negotiations. While Los Angeles remains a powerful and desirable market in the long term, the current correction is hard to ignore. Monitoring interest rates and buyer demand will be essential for making smart real estate decisions in this evolving landscape today. Number 2, Oakland. Oakland has long been viewed as a more affordable alternative to nearby San Francisco, attracting buyers who wanted proximity to the Bay Area without the extreme price tags. During the pandemic housing boom, demand surged as remote work allowed people to move more freely. Home prices climbed quickly, but in 2026, that growth is slowing, and the market is now experiencing noticeable declines. One of the major reasons behind this shift is changing buyer preferences, combined with broader economic pressures. Concerns about safety, rising living costs, and higher interest rates are making potential buyers more cautious. At the same time, fewer people are relocating to the Bay Area compared to previous years. This drop in demand is leading to longer listing times and increased competition among sellers trying to attract limited buyers. For buyers, Oakland may now offer opportunities that were difficult to find just a few years ago. Prices are becoming more negotiable, and inventory is improving. Sellers, however, may need to be more realistic and flexible with pricing strategies. Oakland still benefits from its location and cultural appeal, but the current correction highlights how quickly market conditions can change, making careful decision-making more important than ever. Number 1, San Francisco. San Francisco has long stood as one of the most expensive and competitive housing markets in the United States, driven by its role as a global tech hub. During the pandemic, prices initially surged as low interest rates fueled demand. However, in 2026, the market is undergoing a noticeable correction, with home prices declining across multiple neighborhoods as conditions continue to shift. A major factor behind this decline is the ongoing transformation of the tech industry. Layoffs, hiring freezes, and company restructuring have reduced the number of high-income buyers entering the market. Remote work has also allowed many professionals to relocate to more affordable areas, reducing demand within the city. As a result, inventory is rising while buyer activity slows, creating downward pressure on prices. For buyers, this presents a rare window of opportunity in a market that once felt nearly impossible to enter. Negotiation power is increasing, and more options are becoming available. Sellers, on the other hand, may need to adjust pricing expectations and remain patient. San Francisco still holds strong long-term value due to its innovation-driven economy, but the current correction is significant, making timing and strategy more important than ever today. The California housing market in 2026 is clearly shifting, and what we are seeing is not just random drops, but a broader market correction across key cities. From tech-driven hubs to previously booming suburban areas, changing work patterns, rising interest rates, and affordability challenges are reshaping demand. For buyers, this could be a rare window to enter markets that once felt impossible. For sellers and investors, it is a moment to stay alert, adapt strategies, and think long-term rather than react emotionally to short-term changes. If you found this breakdown helpful, make sure to like this video and subscribe for more real estate insights. Let me know in the comments which city surprised you the most, and whether you would buy during a market dip. Also, check out our next video where we explore cities where home prices are rising fast right now.